Yo, what's good everybody? Welcome to part 5 of the course covering market structure. In today's video, I'm going to be going over the basic principles and guidelines of what market structure is and how to determine market structure. Now, before we dive into this, guys, I want to just be upfront and just come out and say, look, I do not claim to be an expert. I am not an expert. I do not claim to know everything about markets. And, I'm sure that there's people out there who know more than me and maybe have, better ways of determining market structure and whatnot. But this is the way that I determine market structure. It's the correct way in my perspective when I'm looking at the markets. It's what I believe in. And also it is, the exact way that I determine market structure that helped me become profitable. So if maybe this way, somebody comes out and is like, oh, that's wrong or whatever, sure, okay, that's cool, whatever. But this is the way that I trade. This is the way that I believe market structure actually is. Now, let's dive right into it. So, markets can do one of three things. They can go up, they can go down, or they can go sideways, which is known as consolidation or ranging, correct? So, when markets move, price is going to leave behind, a trail of data that creates market structure. And market structure is made up of higher highs, higher lows, lower highs, and equal lows. So what that looks like on a chart is you're going to have something like this. This is known as an uptrend or bullish condition. So you're going to have a low, a high, a higher low, because this low is higher than this low. And then you have a push up, which creates a higher high because this high is higher than the previous high. And then it'll come back, create a higher low because this low is higher than this low. And then you're going to have a push higher, so on and so forth. And obviously this would be the high, the higher high because this high is higher than this high. Very simple, very, very simple. Now on the flip side with that, in a downtrend or bearish structure, you're going to see something like this, create a low, lower high, and then you're going to have a lower low because this low is lower than this low, and then you're going to have a lower high because this high is lower than the previous high, so on and so forth, creating new lows. These lows are lower than these lows, so on and so forth. So that's down, a downtrend, or markets are moving down, bearish structure, whatever you want to call it. And then the third thing, like we said, markets can move sideways, which equal highs, equal low, equal high, equal low, equal high, equal low, so on and so forth. This is known as consolidating or ranging. Those are the three things that markets can do. Now, identifying market structure, it helps you form a bias on what direction the market is trending. Now, you should always place your trades in alignment with the trend. All throughout your trading journey and your trading career, you're going to hear people, your Forex mentors, your gurus, whatever, they're always going to be saying, trade with the trend. The trend is your friend. Reason being, guys, these markets are massive. Like we've previously stated, $6.6 trillion traded every single day. Your little $10,000 account or whatever trading account, even if you have $1 million account, you're not going to move these markets. These markets are going to go where they want to go. So that's why it's very important to not fight the trend. If the trend is going up, you should be looking for buys, okay? And you determine if the trend is up based on higher highs, higher low, higher high, higher low. That is deemed, bullish structure or an uptrend. You are looking for buys. Flip side, you're looking for sells in bearish structure or, downtrend, whatever you want to call it. How do you identify that? You identify that with lows, lower high, lower low, lower high, lower low, okay? And you're looking for sells in those types of market structure conditions. And then obviously over here, if you're seeing equal highs and equal lows, you should just be sitting on your hands. You shouldn't be trading at all. Remember, during the psychology section, we talked about, there's going to be days when, markets are choppy and there's just no direction and so on and so forth, right? And the best thing to do in that scenario is nothing, right? You want to do nothing in these types of market structure conditions. And, just kind of wait until there is a breakout or a change in structure. Now, how do you identify these changes in structure? See, I have very strict rules in my own way of determining market structure flips and when the trend, flips and changes. But I'm going to share that with you guys right now. So let's say we're in a bullish structure or bullish trend. We're getting higher highs and higher lows and higher highs, and holy shit, the market's going up, right? So market structure is only flipped. It only becomes a bearish trend whenever the last significant higher low is broken. Now, how do you determine that? The last significant higher low is the low that created the current highest high. Okay, so this is the current highest high. The low that created that push is deemed the last significant higher low. It's the higher low because this low is higher than this low, and it's the last significant one because it created the push for the the new highs. Now, market structure becomes bearish when this gets broken. So if it looks something like this, now I would deem that as bearish structure. Because why? Because we have now flipped, because the last significant higher low has been broken for a downtrend. Now, let's say the market looks something like this, and it comes down, it goes like right here, and now some people will look at this and say that this is now bearish structure because we are getting, lower highs and lower lows and lower highs. But I still believe that this structure overall is bullish because these are the highs. We did not break these highs. So now that means that this is still the last significant higher low. And we have not yet broken that. So we should still be looking for buys. But on the flip side with that, let's say, the market does something like this and creates new highs. So now what happens? The only thing that happens is this is no longer your last significant higher low. This is. Why? Because this is the low that created the push for the new highs. That's a very simple way of determining market structure. Now remember, it can do whatever the hell it wants as long as it doesn't create new highs or as long as it doesn't break the last significant higher low. If it does this, now we flip to bearish structure and so on and so forth. Now, determining when a bearish structure or a downtrend flips, it's the exact same thing, just a little bit different. So obviously right here we have bearish structure because we're getting lower highs and lower lows and lower highs. Lower high because this high is lower than the previous high. This it's a lower low because this low is lower than the previous low. Very simple, right? So in this example, let's give it a little more touch here. Okay, so in this example, this market structure is bearish all the way until the last significant lower high is broken. This is the last significant lower high. Why? Because this is the last high that was that created the push for the new lows. So this is the lowest low, the new lows, fresh lows. This low is lower than all these lows right here, correct? Cool. So this market structure is bearish until we get something like this, until price breaks the last significant lower high. This is the last significant lower high because it is where the push to the lowest low was created. It's very simple, right? Now, obviously, on the flip side of that, same thing as if we were in bullish conditions. It does not matter what the hell it does in between right here. Okay, some people will look at this and say it's bullish structure because you're getting higher highs. I don't see it that way. I see it as it's still bearish because we have not yet broken the last significant lower high. Now, obviously, that changes if price breaks that. If we're like this, now I would look for buys because we're in bullish structure. Or if we get something like this, and boom, now we have new lows. So now what happens? This is no longer the last significant lower high. This is. Because why? Because this, from this point, was where the new lows were pushed. This low, the new lowest low, is lower than all these other previous lows. So now that means this is the last significant lower high because it's from where that low was, that push started. It's a very simple way of determining market structure and market structure flips. Now with that, the last example I'll give is, so obviously the last thing markets can be doing is moving sideways. We're creating equal low, equal high, equal low, equal high, equal low. Now I'm not going to explain this too much. It's very simple. What's an equal high? Well, it's probably when these highs are equal in relation to the other highs. Very simple, right? Okay, and then it's the same thing for the lows. These are equal lows. This market structure is called a range, consolidation, sideways movement, whatever. All we know is when we're seeing this shit, Get away from the computer because there's nothing to do in these scenarios. I'm sure there's probably some people out there who trade this, but I'm telling you, for the majority, remember, you want to trade with the trend. And right here, there is no trend, right? It's consolidation. There's no trend. So now you have, remember, trading, if you want to trade with the trend because the trend is your friend, and right here there is no trend, that means you have no friend, right? You don't want to go into a market, where there's $6.6 trillion traded every single day with no friends, right? Wait for a trend to happen. So what are you looking for in this scenario? All you're looking for is a breakout. You can either look for a breakout to the downside. It doesn't matter. It doesn't matter what happens. It could do something like this, and it becomes a breakout whenever new lows are created. And how do you know if it's a new low? Because this low is lower than the previous lows. Very simple. So now this is the start of bearish structure. So now what we can anticipate is to start seeing, lower highs and lower lows and lower highs and lower lows. And of course, it's bearish structure until what? Until the last significant lower high is broken. So now we're looking for buys because it's bullish structure, so on and so forth, right? But now let's take it back to right here. Now let's say we're back in consolidation. One thing we can be looking for, like we just discussed, is the breakout to the lows. Now what happens if it does something like this? Boom. So now we have new highs. Why is this a new high? Because this high is higher than the previous highs. So now we can anticipate what? A new higher low, because that's what follows up with bullish structure. So now I'm looking for buys. Looking for buys in this types of structure all the way until we get something like this. Because what just happened? Now we've broken the last significant higher low. I mean this is very basic, right? This is elementary type shit. Okay? So now what are we? We're bearish structure because we just broke the last significant higher low. So now we're looking for sells, so on and so forth, lower high, lower low. Okay? That's the basics of market structure. Now, with that being said, you need to understand that if you show up to the charts and it is hard for you to identify what the market structure is, if you can't tell if it's bearish, bullish, or consolidating, the best thing you can do is what? Leave the charts, because all you're going to be doing in that scenario, if you got some shit that just it's what's the structure? We don't have a fucking clue, right? In this type of shit, if I see this, I'm just gonna leave my computer. I'm done for the day. I don't care what happens. This is ugly. There's nothing to be done in this scenario. The only thing I'm gonna wait for in this scenario is market, to figure the fuck out where it wants to go and start giving me trending conditions. Once I see this, now I'm back in it. Now I'm back dialed in looking for setups. But unless I'm in trending condition or market structure is really easy to identify, just stay away from the charts, because the only thing you're going to do in that scenario is try to force trades that aren't there, and you're putting unnecessary capital at risk. Does that whole thing make sense? I hope so. Now, obviously, easier ways to identify market structure is, let's say you're trying to look for, market structure on 15-minute time frames or, hourly time frames. Just know that if you go up to a 4-hour or daily, market structure is going to be a lot easier to identify. And then also, with that being said, the daily and 4-hour and pretty much the higher time frames, so the weekly, the daily, the 4-hour, those market structure, or the market structure on those time frames, is going to be heavily more favored over lower time frame market structure, just because it's a bigger trend on the daily. So that's the most basic way I can define market structure. Obviously, you're going to get better with at identifying market structure the more you practice. So, don't be afraid to dial up your TradingView and practice these scenarios with the good old path tool and draw some cool shit and identify your own market structure. That is it for this video, guys. I hope you enjoyed it, and I hope it all made sense. In the next video, we're actually going to go on to charts and identify market structure on live candles, or not live candles, but actual, candlesticks, and try to identify, market structure. And I hope this really made sense for you guys. With that being said, I'll see you guys in the next one. Peace.